Come on in. Come on over. Take it away. Oh. Then it turns off. Okay. Do you have to go super close or okay? No. No, no. Okay. All right. I have a confession to make. Anyone can prepare a tax return. So why am I here? For a long time now, I've seen a lot of tax returns prepared incorrectly, or tax returns that could have been prepared differently. Oh. In the end, it's all the same. Money was lost. Today, I will share 5 tax secrets that could help save you money. We'll go over mortgage interest. Sorry, up here. Okay. No worries. Today, I will share, we'll go over mortgage interest, points, the pass-through entity elective tax, the qualified business income deduction, and clean energy tax credit. Let's start with legal secret number 1. Mortgage interest paid on your main and second home may be deductible. So mortgage interest is interest you pay on a loan secured by your home. So you're allowed to deduct interest on your main and second home. So I've listed what is considered a home for your reference. Mortgage interest paid is reported on tax form 1098, and I'll show you what that tax form looks like on the next slide. Mistakes to avoid. Assume mortgage interest is always reported on one tax form. So you will receive multiple tax forms if the loan was sold or refinanced. Next, rely on the mail. You may need to retrieve the tax forms online or contact the lender directly. Here's what the tax form looks like. So I had a client this year that provided me with only 2 mortgage interest statements. The first from her old loan, the second from her new refinance loan. I went back to the client and told her the numbers just didn't make sense. By the time I completed her tax return, she had a total of 5 statements and $13,000 of deductions that could have been missed. The client didn't realize her loan was sold multiple times. She was able to retrieve 1 statement online, and the rest she had to email or call the lender directly. Legal secret number 2. Points paid on a purchase or refinance may be deductible. So points are charges prepaid by the borrower to obtain a mortgage. So you can incur points on a purchase or refinance, and it may be up to 100% deductible. So points paid are reported on the settlement statement, the tax form 1098, or the refinance closing disclosure. Yes. Yeah, so there's a lot of I guess different names, loan origination fees. It's basically it charges by the lender, so you can get that mortgage, whether it's buying down a rate or just qualifying for that loan. They're basically charging you upfront to get that loan. And usually it'll state on your settlement or your purchase statement. And the lender or the loan officer should disclose that to you, how much the amount it is that you were prepaying. Yes. the points are, so when you purchase a home or refinance, the settlement statement is when you purchase a home. So that kind of itemizes, the purchase price, all the expenses that you're paying technically. And then so the tax form is another place that it's reported on. Like it can be reported on. Yes. Points are costs that the borrower is paying for, that you get to deduct. Does that answer your question? So mistakes to avoid. Overlook the points reported on the tax form. So I'll show you where it's reported on the tax form. Next mistake is rely on the tax form. So again, points aren't always reported on the tax form. You may need to refer to the settlement statement or the refinance closing disclosure if you're refinancing. So points are reported on box 6 of the tax form. So I had another client this year that refinanced, and box 6 of his tax form was blank. So I reviewed his refinance closing disclosure and found over $10,000 of additional deductions that could have been met. Oh. Moving on to legal secret number 3. A partnership or S corporation may deduct taxes paid on behalf of partners, members, or shareholders. So this elective tax is really geared towards partnerships and S corporations. So yeah, no worries. Correct. Yeah. So the question was, if you own a partnership with someone else, the question was if you have to pay taxes on that income from that partnership. And the answer, depending on what the ownership percentages are. So if it's 50-50, then you pay 50% and your brother will pay 50%, or whatever is stated on the partnership agreement. Actually. So the California, again, pass-through entity or PTE elective tax is available to partnerships and S corporations. So a partnership and S corporation can elect to pay a 9.3% California tax on behalf of its partners, members, or shareholders. So since the partnership or S corporation is paying the tax, it's then allowed to deduct the tax paid on its federal business tax return. And the partner, member, or shareholder is allowed to take a tax credit on their personal California tax return and reduce their California taxes. Go to the next one, sorry. Yeah. So this election is made annually, and it is available for tax years 2021 through 2025. There are 2 payment dates. The first payment is due on June 15th, and it is the greater of $1,000 or 50% of the elective tax paid for the prior taxable year. The second payment, which is the remaining amount due, is due on or before the original tax return due date. Mistakes to avoid: not have current financials, or simply not know your current financial status. So this elective tax is deductible in the year paid. So by keeping current financials, allows you to make better informed decisions and maximize your tax benefit. Next, forget to make the payments timely. The key date here is June 15th. Legal secret number 4. So self-employed and certain business owners are allowed to take up to 20% deduction on qualified business income. So the qualified business income is an up to 20% deduction on qualified business income. Note, it's a free deduction. I won't dive into specifics, but want to mention that it's subject to limitations. Mistakes to avoid: not have current financials. I can't emphasize enough how important it is to keep current financials. You need to know your current financial status in order to make proper adjustments and maximize your deduction. Which leads me to the next mistake to avoid. Not know what adjustments to make to maximize your deduction. So this comes with understanding the tax laws as well as your personal and business situation. And legal secret number 5, there are tax credits available for clean energy upgrades. So the Inflation Reduction Act just passed last month, and I wanted to highlight some of the clean energy incentives available. So the new electric vehicles, you can receive a tax credit up to $7,500. For used electric vehicles, it's $4,000 or 30% of sales price, whichever is lower. For home charging stations, it's $1,000 or 30% of installation cost, whichever is lower. For solar panels and other renewable energy, it's a 30% tax credit from 2022 through 2032, and there's no dollar limit. For energy efficient home improvement credits, starting in 2023, you'll get a tax credit of 30% of cost with a $1,200 annual limit. So this means that you can claim this $1,200 every year, as opposed to 2022, it was capped at $500. So the solar panels, specifically, you get a 30% tax credit. So these are other home energy improvements. And here's the list of the amounts for certain improvements. Yes. Yeah. So these are the tax credits available for these certain upgrades. So, the question was if there's certain water heaters that qualify for this tax credit. I believe if there's a website where it's kind of specifies the specifics on what type of upgrades available, but I think the water heater is still, and this is still included for this tax credit. For the heat, so this was in regards to water heaters, if it's a heat pump. So electric or natural gas heat pumps, water heaters. So it's electric or natural gas water heaters. So the high efficiency home rebates is available to low and moderate income families, and they can cover up to 100% of costs. And you can receive up to $14,000 per household. So this is not a tax credit. So this is something that you would need to apply through the state. I've listed some of the rebate amounts for certain upgrades. They're also in your slide. So before, oh yeah. Mm-hmm. I think windows are classified as different than solar panels. So the question was if the solar windows will qualify for the 30% credit similar to the solar panel. And I believe that, so this new bill was passed recently. There's not too many, detail and specifics, but from my understanding, it may appear that the windows are separate from actual solar panels. Yeah, because the windows are specified separately. For the energy efficient windows are listed separately for a different amount, as opposed to the 30% tax credit. This is, it's specifically solar panels. Yeah. So the mortgage and points was, oh, go ahead. Sorry. So the question, sorry if points was a big deduction that was missed from my clients. And the answer is yes, because of the low rates, I had a lot of clients that refinanced. And this, I noticed that the tax forms were inconsistent, where sometimes the points would be reported in the tax form and sometimes it wasn't. And I think, yeah, so, I always, would request a copy if you're buying the settlement statement, or if you're refinancing, the refinance disclosure, to kind of just double check to make sure that, there's there's not any deductions that you're missing. I think a lot of people kind of generally think that, okay, if it's a tax form, I need it for my tax return, and kind of overlook other documents, that might have tax deductible items because it doesn't necessarily say tax form. Okay. Did I answer your question? Okay. Yeah. So the biggest thing too is for real estate, if you're a business, and I mentioned the pass-through entity elective tax. So this was new for the 2021 tax year. I had all my business clients take advantage of this deduction. But I know, other business owners that were friends that, completely missed out. And so this was a huge thing for the 2021 tax year. And the qualified business income deduction that I just mentioned also is also fairly new. And they missed out on maximizing deduction. The pass-through entity was something that the pass-through entity elective tax was something that, business owners missed, while the qualified business income deduction, the 20% deduction, was something that I saw business owners did not maximize because of the limitations and not making any adjustments before the year ended, and it was too late. So yeah, so I kind of the deductions that we went over were something that I did see a lot of, and that's why I wanted to share it with all you. You're welcome.
My thought is that we let Brian Harps come up and give his presentation, and then at the end we have both of them up here and we ask questions, because he might answer some of the questions that maybe you're going to ask. So thank you, Laura. Woo! Thank you. Yeah. Thank you. That's your water. Oh, okay. Yeah, we'll do those at the end. Okay. Yeah, we know we had received a few questions, so we'll answer those at the end. Okay, so just hang tight. Thank you. We have Brian Harps, our tax attorney here. He's back. He was here with us. Was it last month or 2 months ago? So thank you again, Brian, for taking time.
Try to get all this right. There's a lot of things going on in my hands right here. Okay, like Brenda said, my name is Brian Harps, and this is my second time being back here. I really appreciate the opportunity to speak in front of people. I know taxes aren't everyone's favorite topic, but they are mine, and I have the microphone, so this is a big moment for me. That's me. Just give you a little background about who I am. Like Brenda mentioned, I'm a tax attorney. As I'm sure Laura's can attest to and has worked in the past, many attorneys out there know just enough about taxes to be dangerous. So she's probably had a lot of confrontation, not necessarily confrontations, but conversations with them where she's had to educate people. I kind of fill that gap where, I'm a lawyer, I know the law, but I also really like taxes. So I have a real nice hand in glove relationship with accountants. And this is my second time here. And if I come back a third time, I will let you know the secret story of how I became a tax attorney. It was not on purpose. So I just want to see how this goes. So what I'd like to do today is basically, give you a little primer on how taxes work as it relates to real estate transactions, both of the principal residence and investment property. And then we'll just generally also talk about property taxes. Property taxes are one of those things that affect every property owner in the state, but they really don't get their just deserve. It's often one of the things that people don't plan or think about. And on an ongoing basis, with the way property taxes work in the state, they can be, some of the highest taxes you end up paying over the course of your ownership of a piece of real estate. So they really do deserve a little more time as far as I'm concerned. My goal will be just to kind of give you a broad primer of this. I don't want to turn you into someone like me or Laura, but I also don't want to turn you into a zombie either. So, we're just going to kind of talk about this from a broad perspective so that you understand a little bit about taxes and are at least aware of some of the issues that come up, not necessarily experts. You don't want to be experts. So our first thing we're going to talk about is, let's say you have a family that owns a piece of real estate as their principal residence and they decide to sell it. One of the things that you have to remember is equity is not important. I've had lots of fights with people where they talk about what the equity in their property is, and they think that is the foundation of where taxes start. It's not. The foundation of where taxes start is what's called your basis, which is essentially your purchase price in a piece of property. So I've had people that have had, a piece of property, they pulled money out, they've done HELOCs, they've basically, taken all of their equity out of it. And when they sold it, they got a very small amount on their settlement statement. So they didn't think they're going to owe much in taxes at all. But the reality is they owe based upon what the purchase price or basis is. So the general formula in California is you've got your sales price reduced by the purchase price and any potential Section 121 exclusion, which means if you're married or single. If you're single, you can take another $250,000 off the top. If you're married, another $250 on top, $500. That would equal what we call your taxable gain, and then that would be multiplied by your rate. If it's long-term capital gains, it could be 10, 15, 20%. But that's the general formula. Now, in this example, what we're going to do is we've got a single person who sold a piece of property for $1 million, bought it for $500, and because they're a single person, they get the extra $250 on top of that, which means their taxable gain is $1 million minus $500 minus $250 equals $250,000. It does not matter what the equity is. That's the gain. Then that would be multiplied by whatever the is in their situation. Make sense? Simple enough? Guys, it really is that simple. In this case, we're just going to do a married couple. So instead of the $250 right here, we've got $500. So the exact same scenario. $1 million sale price, $500,000 purchase price, $500,000 instead of $250 for the Section 121 exclusion creates zero taxable gain. Again, doesn't matter what the equity is. That's the formula. So basically the only difference here, the only variable here is whether they're single or married, and whether or not they get $250 or $500 off the top. Okay. Investment property. So instead of a person selling their house, now they're selling maybe a piece of rental property if they own. In that case, there is no Section 121 exclusion. So the $250,000, $500,000 that we just talked about, it's gone. The difference with investment property is on an ongoing basis, they get to deduct depreciation. So that's essentially the trade-off is you don't get that exclusion, but you can take depreciation. Depreciation is based upon whatever you purchased the property for, reduced annually by a fraction, 29.5 years equals your depreciation. So in this case, you get your sales price, less your basis, which is the purchase price, reduced by depreciation equals taxable gain. Gain times the rate equals tax liability. Same idea. So with this example, if we've got the $1 million home, they bought it for $500, but they've already depreciated $250, means they're taking $250,000 instead of $500,000 on the top. So you've got a $750,000 taxable gain. It's a little different. Does that make sense? Yep. So there's a fraction that's built into the code with residential real estate. Basically, what you take is your purchase price divided by 29.5. That equals your annual depreciation that you then are allowed to recoup every single year. The byproduct of that, though, is it erodes your purchase price. So if you've held it the entire time, this will be zero. You've already recaptured all the depreciation. And I use the recapture word because it's an extra wrinkle here that I was just talking about earlier. We're not going to get into as it's really, really complicated. But basically, the thing to remember here is with rental property, it's a wonderful thing that we can depreciate things. We can get our money back ongoing instead of waiting until we sell it. But you got to pay the piper when you do. And that's how it works. There you go. That's the recapture word that I was just talking about. So excellent question. So what was asked is if the tax on the depreciation is the same as on the taxable gain. The answer is no. The depreciation is taxed on what we call your ordinary income, whereas the tax gain is capital gains rates. So you can have a fairly wide dispersion of maybe, a top tax rate, 37, 38, 39% on the depreciation recapture, and maybe only 15 or 20% on the taxable gain with the original basis. Really complicated stuff. Great question. It's out there, but just the general idea to remember is depreciation, you get it as you go, but you pay for it later. Whereas with a regular sale of a residential real estate, no depreciation, you have to wait till you sell it. Now, the additional wrinkle with investment real estate is the like kind of rules. I'm sure everyone's heard the term like kind, right? Excellent. Some say yes, some say no. Basically, what it means is if you have an income producing piece of real estate and you sell it, and you roll over that gain into what's called a like kind property, meaning another rental investment real estate, you can defer the taxable gain. You can then pay the gain later when you sell what's called the replacement property. The rules are very complicated. They all deal with timing, and most of these transactions are done via escrow. So if you're ever hearing or considering a client that wants to talk about like kind, always involve a qualified escrow. In California, you really can't do like kind transactions without escrow. So it's just one of those things where you can know all the rules if you want to, but the reality is you're going to have to circle in with an escrow company. Just remember that when you hear like kind, think escrow. But the general idea is you can take that gain, you can flip it into a new investment property and defer the gain instead of paying it and then buying a new property. Does that make sense? Excellent. So here's the one I'm really looking forward to talking about, because like I said, property taxes, California property taxes, they just don't get enough consideration as far as I'm concerned in the broad context of things. The way they generally work is you have your assessed property value of a piece of real estate, oftentimes based on the purchase price, which then goes up or down every year depending upon the market, equals a adjusted value, which then multiplied by your tax rate. That's how you get property taxes, just the general formula. But in California, we have Prop 13. Has everyone heard of Prop 13? It's always in the news every election cycle. Basically, what Prop 13 says is that it doesn't matter how much a piece of real estate goes up in value every year, the cap is a 2% increase in your property taxes. So this happened back in 1978. Back in 1978, no one had any idea what was going to happen with California real estate, particularly the last 20 years. So what we have right now is a situation where a lot of people view our property tax basis to be out of balance with the value of properties because, the last, beginning of the pandemic to now, properties are up, 10, 15, 20%? My goodness. But they can only go up from a tax perspective at 2%. So you can see how there's a pretty good variation between what the actual potential tax value is and what we're actually paying. And that's due to Prop 13. Whether you like it or not, it's just the rule. That's all you got to do is remember Prop 13 caps at 2%. Prop 58, this is the old rule. And I say it's the old rule because it just basically got overturned back in February of 2021. It's still important to know because a lot of transactions that it covers, even though they're in the past, are still relevant. And essentially what it means is if you had a family that owned a piece of property with a very low tax basis as a result of Prop 13, they could then transfer that property to their children, and their children could inherit the low tax rate. There would not be a reassessment. That's the old Prop 58. It was changed about a year ago, but it still applies to old transfers. So it's definitely something to keep in mind. The new rules basically say that you can still do that. You can still transfer the old tax basis. However, there are some pretty strict rules that have to be followed, meaning if your children inherit a piece of property and they want to keep the old tax basis, they got to move into it first year as opposed to just receiving it. Additionally, if the property is worth over $1 million, then the difference between the value and $1 million is going to be reassessed. They're only protected up to $1 million. So under the old rules, you could transfer Hearst Castle to your kids, and it was not going to be reassessed. Now you're at that 1 million, you get that, but everything above that is going to be taxed. Please, Brenda, do you want to do questions at the end, or I know you mentioned? Oh, please. Okay, great. So why? By all means. Great question. It has to be, and she's asking if you inherit multiple properties, if you have to become an occupant of every one for this to apply. Is that what you're asking? Okay. It only applies to principal residence. So whichever one mom and dad lived in, that's got to be your principal residence. And you only get one principal residence. I know, I know some people say, you know, where does everyone's summer? But that does not apply here. You only get one from a tax perspective. So Prop 19 changed the old 58. Basically, effective February 16th, 2021, every transfer going forward is now subject to these new rules. Long and the short is you can still retain an old property tax basis, but it's a lot harder to do than it used to be. Then Prop 60 and Prop 90. These rules have been on books for a very long time, and a lot of people don't know about them. Basically, what they say is an older individual, 55 or above, if they've been living in a home for a long time that has a low basis, and they want to downsize, maybe they want to buy a condo, they want to get out of their old house, they can take their low property tax basis with them to the new home if certain rules apply. Basically, the general rule is that the new home is equal or lesser value than the replacement home. So if you got a single family residence that they raised 3 kids in, and now it's just too much for them and they want to move to a small condo in the desert, as long as that condo in the desert is worth equal or less than value to the home that they're getting out of, they can take the old tax basis with them and keep it. So it's a good thing, helps people that are older, maybe on a fixed income, get out of larger residences and into smaller ones. That's a good thing from a realtor's perspective, because a lot of people are scared. They want to downsize, they want to get their houses, but they're concerned about their costs increasing. So this is something you advise your clients that, no, we can actually keep your costs exactly where they were, and you can get, you know, a shinier, newer, smaller house that feels a little bit better for you. So that is everything in a nutshell, guys. You all have my slides. I'm happy to email them to you. I know Brenda talked about we're going to do a quick Q&A right here, so I'm more than willing to. But basically, the long story short here is, you know, there are a couple rules when it comes to selling property, and there's a couple rules when it comes to property taxes. You don't need to know them all by heart. Just know that these rules exist, and you'll be okay. All right. Thanks, guys.
Okay, so we'll open it up to questions for our folks that are on Zoom. Please feel free to go ahead and type it into the chat box, or anybody here. Any questions for either one? Yes.
60-90 thing, that's only if you're remaining in California, correct? Okay.
Our property tax rules do not apply in other states.
Example you gave of taxable gain. What about improvements that you put into your property? How does that play into your, what ends up being your taxable amount?
The general rule is that improvements, what we call capital improvements, increase your basis. So they would be added into your purchase price. But whether or not something is what we call a capital improvement or just an ongoing expenditure is actually pretty complicated. If you ever Google online in DOPCO, you'll see that there are about 3,000 legal cases talking about what is a basis increasement versus an ongoing expenses. Laura's nodding, but the general idea is just that, you know, some money reinvested into your home can increase what we call the basis, others cannot. Just depends. So that's the famous legal answer is, you know, before you go to law school, someone asks you a question, the answer is I don't know. After you go to law school, someone asks you a question, the answer is it depends. So the answer is it depends, but great question.
And I get a property. And I want to knock down the front house because it's already messed up. Actually, the both properties are no good. So you can start knocking down that one, redo that, maybe put, I don't know where I live, you have to put units up. So maybe you put 2 or 3 units in the front and maybe 2 in the back. And this age thing and the 60 qualify me for something?
That's even more. Yes. Because that is what is technically construed as new construction. And it probably will be if we're really gutting the thing, then they're going to reassess 100% of the property. So we're back to it depends. It depends, but the general rule is if it's new construction and someone takes a look at the property and says, no, this is a wholesale rebuild, even if you're leaving a couple original walls or fixtures up, then they'll reassess the entire project. Now we're talking about planning whether or not something is up to code versus whether or not something is a taxable reassessment. Those are two completely different departments. So whatever city codes require, for example, to get permits that you leave certain original structures up, don't apply to the county tax collectors. Right. So.
Laura, that's a great question about sellers, because when we meet with sellers, we ask them for a list of all of the upgrades that they've ever done. And we tell them that it's for two reasons, right? We need it for marketing to sell their home and to get top dollar, but they're going to need it when they sit down and meet with you, their CPA, right? What do you see? Doing it, how can they keep better records of it, or what do you recommend?
Oh, that's a great question. That's a really great question. Well, this is just a recent client. I was fortunate enough that her upgrade was recent. So she did have the invoices available and could, track down her checks that went out from her bank account. So, I mean, in this scenario, sorry, it's like the client that just came off the top of my head. In her case, now that everything's digital, she was just fortunate enough to just have everything available to her online. But for those, and I think of my parents, that are planning to sell and have, done construction multiple times on their homes throughout, I don't even know how many years now, I think with taxes, in that case, I mean, we do the best we can, right? At that point, we can estimate about how much was done, sit down, because everything was, through a refinance or, a loan. So at that point, it's not, we can argue that the improvements that were made, we estimated it the best we can. And I think it really, once you apply the exclusion, if you're, if your gain is far from meeting that $500,000, then, it's not such a, it's not such a big deal if, you're not if your improvement is not, so accurate. But I guess that would be my advice for someone that has lived in their, home for so long and done so much construction, to kind of just, again, list down like kind of what you've done to your home and maybe kind of estimate about how much it would cost. And I guess that would be the best way to kind of navigate around if you don't have records to, really add up all your improvements.
So word to all the homeowners or will-be homeowners is just to keep records of everything that you spend, all the improvements, because I see sellers all the time scrambling and they're trying to they're remembering 30 years back. And I know that's a challenge. Any other questions?
Well, a long time ago, back in the 50s, I guess, my dad bought a property and then borrowed against another property. Is that still something people can do?
Oh, we have a lender in the house.
Yeah.
That sounds like a lender question, right? Yeah. We have Marisol from Financial Partners here.
You can, as long as you qualify for the next home with the cash out that you took out on the other home. So you can.
I gotta knock all of it down. So I would inherit another 2 properties, and the one for those 2 properties hopefully the same value as that one, so I can borrow against it. Is that allowed still?
It would be considered either a refinance or a home equity line of credit, but usually a home equity line of credit is not allowed if it's not your primary residence. So more than likely it'll be a cash out refinance to borrow against it on the equity to purchase or renovate another. But definitely.
Convenient. Thank you, Marisol, for being here. Anyone else? You guys were so lucky because both Laura and Brian have given us their slide presentation and have given us the authorization to email it out to everybody that's here with us and everybody on Zoom. So you will receive a copy of it. Oh yeah, there's a couple of questions that we had sent in. So Laura, can we get her presentation up, please? It's towards the end. we're going to answer a couple questions that were emailed prior to the presentation. Here we go.
So one of the questions was how to better manage rental property deductions. So I recommend using a separate bank and credit card accounts for all rental related property expenses. This just avoids you combing through your personal accounts or, if it's intermingled, and avoid missing deductions. Next, if you can, you could also work with a property manager and they can keep track of all your expenses. Okay, the second question was tax considerations for newlyweds who plan to file jointly. So it really depends on the income and deductions that each person brings. There's different, rules for married filing separately and married filing jointly. But the easiest way really is to prepare 2 tax returns and compare which yields the most benefit. Or you can work with a tax professional and, that can analyze that for you. And then the last question was how the mortgage interest tax deduction works and how to leverage its benefits. So the mortgage interest deduction is deductible only if you claim the itemized deductions. This means that your total itemized deductions must be greater than the standard deduction. So the standard deduction depends on what your filing status is. I believe for married filing jointly for 2022, it's $25,900. So your itemized deductions, which includes, your medical and dental, state and local taxes, your mortgage interest and charities, it needs to be above that $25,900 for you to be able to receive a benefit for deducting your mortgage interest. So I want to mention that there's a $1 million or $750,000 debt limit on the interest that you can deduct, depending on when you incur that debt. Okay. How to leverage its benefits. So you can claim the mortgage interest on the tax return that yields the greatest benefits if there's multiple owners. So I have a client that the property that's owned by a mom and a son. So in this scenario, the mom wouldn't benefit in claiming the mortgage deduction. And so the son claims it 100%. Another way is, so there's different tax treatments also for rental property or rental properties with services rendered. So this is also another way, to kind of be able to deduct the mortgage interest, say if you have multiple properties or are subject to the loan limit. And I think that was all the questions.
Thank you, Laura. Anybody else? We're so lucky, you guys, to have the great CPA, the best CPA and the best tax attorney here with us. And they're going to stick around and hang out with us. And those of us that are here get to have dinner. We have great Mediterranean food. But if you think of any questions, we're going to email out the slides and their contact information. Please reach out to them. We only align ourselves with the best in the business, and they really, truly are. I also wanted to announce our next seminar for October will be an investor seminar. So we're going to have somebody come out and talk about out-of-state investments. And we have one of our reps that actually flipped 200 properties, and he's going to talk about flips and what that experience was like. So that's going to happen October 13th. And looking forward, I know we had requests for short-term rentals. So we're going to have somebody come and speak about short-term rentals. So if there's anything that you want to see, please email us, call us, text us. We're committed to bringing education seminars to everybody. So thank you, everyone. We will send you the slides. Thanks for joining and have a good night. Thank you. Yay, that was good.